So I got a little activity that you can do at home tonight. Do it alone or maybe with your other half after dinner instead of watching Netflix. It's a risk calculator. You input your ages and basic info and it just spits out how likely you are to die, suffer a serious illness, or be out of work for over a month. Yeah, you should probably just watch Netflix. A 61.6% chance of one of these three things happening for me or my partner over the next 30 years. Being out of work for over a month really driving up the numbers here, obviously. In my 20s, it never really crossed my mind that something like this could happen to me. Now in my mid-30s, I look at it and I think, all of these have happened to me or I know someone that they have. During the COVID lockdowns, my partner's business had to shut down for 18 months with no financial support. I was sucker punched in the face by a random stranger on a night out once, which led to me taking time off work. My business partner Luke, who works with me on financial interest, he's an absolute legend. He got cancer in his 20s and he wasn't insured. And my biological father passed away when I was 11.
And it's worth understanding that, if you look at a typical school class, one of those children will lose a parent before they were 18, one in 29. Well, I was one of them, so which is why I'm so passionate about this.
Bear in mind, this is just one company's numbers. There are lots of these calculators out there, and I don't know which one is best, so I've left a couple below for you. But I do know that this isn't a very nice video to make or watch, but regardless, I think it's an important conversation for us to have. I don't want to sit here and scare anyone, but getting punched in the face by a randomer on a night out changed my perspective on the whole "it won't happen to me" thing. And as a result, pretty much straight after the event, I got insured. I wish at the time I had more information on the products available because the process was a little bit confusing and I just wasn't sure if I was being sold to or buying the right thing. In a survey on buying insurance, 88% of respondents said a major barrier to them buying the products was it not being easy to understand or the benefits being clear. So let me just give you at least the information that you need to understand some of these products that are available to you so you can decide if this is for you or not. We're going to cover 3 broad insurances that cover these 3 risks: life, income protection, and critical illness. I'll look at what they do, the potential costs, how successful claims are so you know if they're a scam or not, and give you some insider knowledge on what to look for when shopping around, and just some tips on how to shop around properly. Let's start with life insurance.
It's a life insurance policy.
Oh, that sounds most interesting.
Life insurance is probably applicable to those of us who have responsibilities in life that would be struggled to be maintained if we died. If you've got a long-term partner or kids, and you want to ensure that if you pass away that they'll be okay, this is the product. The average cost of life insurance in the UK is approximately £8 per month for every £100,000 worth of cover. But the costs and types of insurance vary a lot based on age, the length of time that you want to be covered, the amount you want to cover, your health and pre-existing medical conditions. But the thing about life insurance is, it doesn't need to be really expensive. The Association of British Insurers, ABI, publish payout rates on insurance, and I have the 2023 figures here. But focusing on life insurance first, they list 2 separate types of life cover, which I'll explain in a moment. But for whole of life, 211,000 claims were paid, which is a 99.98% acceptance rate. And for life, sometimes called term, there was 48,782 claims paid, an average acceptance rate of 96.7%. The acceptance rates on these types of claims tends to be higher with life insurance because, they're dead tends to be a pretty clear-cut thing. Unless that is your John Darwin, who faked his own death in a supposed canoeing accident to get around £700,000 worth of life insurance claims. Him and his wife even lied to their kids about him dying, so they went through that whole grieving process, but he was eventually caught. So let's break down some of the different types of life insurance that you're likely to see on the market so you understand what they do. There are loads of variations within this, but really we can break this down into 2 broad categories: term and whole. Whole of life guarantees your loved ones a payment when you die, whenever that is. As long as you've kept up with the payments each month or year, they will get that payment. Whole of life can be used in estate planning for tax efficiency purposes, but it's always significantly more expensive than the other type, which is term. Term covers a fixed period of time, this is the term, and if you die within that period, within that term, there is a payout. So you might take out term life policy to pay out any time before your kids turn 20 if you die, but then, they're potentially of working age after that and they might be able to support themselves. With the term-based policies, you might see a few different types floating about. Level, increasing, which you can also see called indexed, and decreasing. So all this means is the amount that's paid out either stays the same across the period, so it stays level. The amount that you're paid on day 1 if you die is the same as if you died in 10 years, or it increases over time, normally in line with inflation to protect the purchasing power, or it decreases over time because you think the amount that you need will reduce over time as well, for example, paying off a mortgage. Coming back to the whole life, you're likely to see 2 broad types here. Guaranteed premiums, which are more expensive, but the payments you make each month don't ever change. Or reviewable whole of life, where the premium, the amount that you pay, is fixed for the first 10 years and then it's reviewed every 5 years after that. so it can change. So clearly there is loads of detail here in terms of the types of cover that you want. You can go really cheap and really basic to really complex and really expensive. But the way I think about life insurance for me and my family is it's the ultimate peace of mind for parents and partners on, what if the worst happens? And the way I think you think about this is, do I want to protect loved ones from me dying for a crucial fixed period, a fixed term, which is cheaper, or do I want to make sure that they get a payment when I die, whenever that is, the guaranteed lump sum? Let's go through some things to consider when shopping around for this. The first one, really important, is it in a trust? The trust allows you to state who benefits clearly from the cover and separates the money from your estate, so protects it from inheritance tax. It's that layer of protection to the life cover that means all of the money goes to the people that you want it to. It also goes to them quickly because it's not going through the probate process, which slows down them getting the money, which would just be an awful thing, at a time when they probably just want the cash so they can focus on grieving. It's really important that you ask whoever's setting up your insurance policy, your life cover, is this protected by a trust? The second thing to consider is don't just think about the main breadwinner. Let's say your family's in a position where you have a stay-at-home parent. Consider that that person provides a lot of value into your household. If they were gone, then you would need to replace them, and that's either going to produce a loss of earnings to you because you need to work less to do all their tasks, or you're going to need to hire someone, which is going to come with an increased cost. So consider protecting both people. The third thing to consider is how much cover. Really individual. Maybe you just want the mortgage paying off, maybe you want a bit extra, maybe you want to make it so that they never work again. The more cover you ask for, the higher the cost. A general rule of thumb is 10 times the salary of the highest earner in the home. If you're still not convinced by life insurance as a product, then just consider the practice of dead peasant insurance, as it's known. It got that name and a very bad reputation due to a big scandal in the 80s where it came out that corporations were taking out insurance on everyone who worked at their business, getting millions if that employee died, while the loved ones of that employee got nothing. By its core, the idea is a sensible one. Corporations in America often take out life insurance on their most valuable members of staff, the founders or the leaders of the organization, to give them a sort of insurance or payout if they die. You are the CEO, CMO, FD, CTO, the whole goddamn board of your family corporation, the key person, so consider protecting Family Incorporated. Critical illness. Critical illness is a cover that pays out a lump sum if you suffer from a pre-specified illness or medical condition. The most common cause of a payout would be cancer. So if you get diagnosed and you meet the requirements and you have this cover, you will get that payment. The average payout in 2023 was £68,000 paid to nearly 20,000 people, and claims are accepted at a rate of about 90%. You have to provide medical evidence here, and the requirements around to what level vary from provider to provider. The crucial thing with this cover though is making sure that you get a really clear idea of what is covered, the terms and conditions. Most insurers cover around 40 conditions, some cover up to 100. Aviva, a big insurer, they advertise 52, but some of the cheaper policies only cover 10. I take a good look at the list before you agree to anything. The big ones though are heart attack, stroke and cancer, and these make up about 80% of all of the claims. Here's a list of others that could be included, and this list is not exhaustive. You also want to understand if you're covered for minor versions of these illnesses, such as partial sight loss, or if it's only full blindness that is covered as an example. Pre-existing medical conditions are going to be harder to get cover for, and you'll also want to see what exclusions there are. So in what circumstances will they and won't they pay out? So one that I found online was they'll cover you for a skiing accident, but not if you're in a skiing race. Many insurers are now offering two types of critical illness options, a core and then a more comprehensive plan. You want to know what are the differences here between the two covers. Don't just pick the cheapest because it's the cheapest. You can also add in children's critical illness as well to the cover, and there are various options here. When it comes to cost, this data on screen is taken from unbiased.com, and it shows the average amount paid per month for £50,000 worth of cover at different ages. The average of all of these is £25 a month. This is a level term, and that means it stays the same every month. You can get decreasing terms as well, which tend to be cheaper over the long run because the amount that you receive decreases in time. The idea being that you potentially need less money if you deal with a critical illness in later life than you do in early life. Income protection. So if critical illness pays out this one-off lump sum, then income protection potentially pays you every month if you're in a position where you can't work, potentially for the rest of your working career. So if you have a life-changing setback, say in your 30s, in theory, the insurance could pay out until the day you retire, until you get back into work, or until the policy ends at a pre-stipulated date, whichever is sooner. Statutory sick pay is paid when an employee is sick for more than 3 days in a row, including non-working days. It's £118.75 paid for up to 28 weeks. These policies instead typically pay out about 50 to 65% of your income each month. They have what are called deferred periods. So this is the period of time that you set with your insurer that basically says, I have to wait this long out of work before the insurance kicks in. This could be 4 weeks, 13, 26, could be a year. The shorter it is, the more expensive the insurance will be. And this is where the combination of critical illness cover and its one-off payment, and then this income protection for the long-term income can be really powerful. They can kind of work together in that way. There were 17,361 new claims paid in 2023, with an acceptance rate of 81.3%. When it comes to cost, a host of factors impact the potential cost. Some of those are on screen. You really want to make sure they classify you as the correct job role because this can really impact the cost, so you don't want to get it wrong. But just to give you an example of potential costs, again using unbiased data, at the age of 25, the average cost for monthly income of £1,500 a month will be £18.42 per month. By 35, this will increase to £26.17, reaching £61.46 a month at age 55. These quotes are based on a 3-month deferred period for a non-smoking office worker with cover running up until the age of 67. So there are 2 types of policy. So you get age cost premiums, which is where the insurer can increase the amount that you pay monthly over time, or a guaranteed premium, which remains fixed for as long as you have that policy. The age cost may seem cheaper at first, but the increases over time could mean that in total it's more expensive than just fixing at a set rate over time. It's worth looking at both and trying to work that out, or speaking to your broker and saying, what are the long-term potential costs of both plans? Okay, some final points then on this insurance topic. It's worth checking with your employer to see what, if any, cover they offer you as part of your employment there. Some do have that, don't overpay, don't double pay if you're already being protected. And for all my limited company directors out there, because you're an employee of your limited company, you can put the insurance through the business and it's a business benefit, it's tax deductible, which is an amazing benefit of being a limited company director. When it comes to shopping around, I would personally say use a broker. Just like I would a mortgage broker really, someone who has access to the whole of the market, who knows the ins and outs and the T's and C's and can give you good advice. They're heavily regulated in this space, so they should give you good quality advice. I've linked 2 below. So one of them is the one that I use, LifeSearch, and the other, Naomi, she was on the podcast. She gave us loads of information in that conversation, and I'll link the episode in the end cards if you want to go into even more detail. I do want to point out that if you mention my name when you speak to the broker or you use the links below, these are affiliate links. So if you sign up, I get a commission when you do sign up. It won't affect the service to you in any way, shape or form, and it does help support the channel. But regardless, you don't have to use the links. Use whoever you want to use because the information, hopefully, that I've given you today applies absolutely everywhere. Okay, final thing. When it comes to insurance, it's not just about the cost. This is about making sure that the insurance that you have actually pays out if you need it. So, seek good quality advice, shop around, ask lots of questions, and don't just pick the top thing on a comparison website because it looks the cheapest. I hope that helps and sheds a bit of light on an area of personal finance we've not really spoken about before, and I'll see you in the next one.